Welcome to Diplomacy Hub, where we explore the complex world of international finance and diplomacy. In this video, we'll be discussing a topic that affects us all: why banks collapse. From the financial crisis of 2008 to more recent collapses, bank failures have had significant impacts on the global economy. So join us as we delve into the reasons behind these collapses, and what we can do to prevent them. Don't forget to hit that subscribe button to stay up to date on our latest videos on diplomacy, economics, and global affairs. Banks play a crucial role in the global economy, providing financial services and facilitating transactions that drive economic growth and development. However, despite their important role, banks can and do collapse, causing significant damage to the financial system and the broader economy. In this video, we will explore the reasons why banks collapse and examine the implications of these failures. One of the primary reasons why banks collapse is due to insufficient capital. Banks rely on capital, or the money they have on hand, to fund their operations and provide loans to borrowers. If a bank has insufficient capital, it may not be able to cover its debts and liabilities, which can lead to a collapse. In some cases, banks may become over-leveraged, meaning they have borrowed too much money and have taken on too much debt. This can be caused by a variety of factors, such as aggressive lending practices, high-risk investments, or poor risk management. If the bank is unable to generate sufficient revenue to cover its debt payments, it may become insolvent and collapse. Another reason why banks collapse is due to poor risk management. Banks take on a variety of risks, including credit risk, the risk that borrowers will default on their loans, market risk, the risk of losses due to fluctuations in market conditions, and operational risk, the risk of losses due to internal problems such as fraud or system failures. If a bank does not properly manage these risks, it can lead to significant losses that can threaten the bank's viability. For example, if a bank takes on too much credit risk by lending to risky borrowers, it may experience a high rate of loan defaults that can lead to significant losses. Similarly, if a bank invests heavily in risky securities or engages in speculative trading, it may suffer significant losses if the market turns against it. Banks are also vulnerable to economic downturns, which can lead to loan defaults, declining asset values, and increased credit risk. During a recession or financial crisis, borrowers may be unable to repay their loans, which can lead to significant losses for banks. In addition, declining asset values can reduce the value of banks' holdings, such as securities and real estate, leading to further losses. During a financial crisis, banks may also experience liquidity problems, meaning they do not have enough cash on hand to meet their obligations, which can lead to insolvency and collapse. This was particularly evident during the global financial crisis of 2008, when many banks faced a liquidity crunch and were unable to meet their obligations, leading to widespread bank failures and bailouts by governments. Finally, banks may collapse due to fraud and mismanagement. If a bank engages in fraudulent activities, such as accounting fraud or insider trading, it can lead to significant losses and damage to the bank's reputation. Similarly, if a bank is poorly managed, it may make decisions that are not in the best interests of the bank or its customers, leading to losses and other problems. For example, if a bank engages in risky lending practices or invests in high-risk securities, it may suffer significant losses that can threaten its viability. This was seen during the subprime mortgage crisis, where banks invested heavily in risky mortgage-backed securities and suffered significant losses when the housing market collapsed. The collapse of a bank can have significant implications for the financial system and the broader economy. When a bank fails, it can lead to a loss of confidence in the financial system, as investors and consumers worry about the safety of their deposits and investments. In addition, the failure of a large bank can lead to a ripple effect throughout the financial system, as other banks and financial institutions may be exposed to losses and credit risk. This can lead to a credit crunch, where banks become reluctant to lend, leading to a contraction in the economy. While there are many reasons why banks collapse, including insufficient capital, poor risk management, economic downturns, and fraud and mismanagement, it is clear that banks must be properly managed and regulated to ensure their safety and stability. It is essential that policymakers and regulators take steps to prevent bank failures and protect the financial system from the negative consequences of these failures. In addition, policymakers and regulators must be prepared to take swift action when a bank is at risk of collapse, including providing emergency funding or arranging for a controlled wind down of the bank's operations. By ensuring that banks are properly managed and regulated, we can help to prevent future bank failures and protect the stability of the financial system, which is essential for sustained economic growth and development. Thanks for watching. If you enjoyed the video, don't forget to subscribe. See you soon.